Seems like we have a great audience today, and we have actually audience from all over the world, from Indonesia, Dubai, Taiwan, Norway, China, Canada, India, UK, Brazil, Hong Kong, Australia, Netherlands, Denmark, etc. And if I have left any other country, please let me know. Thank you. Thank you so much for joining the first Fireside chat on ADA. I also take this opportunity to thank my accounting colleagues and Sac State University for supporting this event and making this happen. If I really introduce our guest today, it will actually take an hour or something to finish the introduction. So I'll be as brief as I can. I've summarized it. So we have the honor today to have a conversation with Mr. R. Harold Schroeder, who has been a board member at FASB since February 28, 2011. Mr. Schroeder has over 30 years of diverse experience, and because of his vast experience, he has a view of the preparation of financial statements and the application of accounting standards from different perspectives, from the lens of an auditor, from the lens of a preparer, and the lens of the investors, among others. Mr. Schroeder has also been a member of FASB's Emerging Issues Task Force from 2008 to 2010. He was also a member of the Standing Advisory Group for the PCAOB. Mr. Schroeder earned his MBA from Tulane University and a Bachelor of Science degree in accounting from the New Orleans. Welcome, Hal, to our Fireside chat. So we will not spend too much of time on other things, but before we start, can I request everyone to kindly mute yourself till the moderator requests you to unmute, please. And please send your questions to the chat box, and we will try to answer all the questions towards the end of the conversation. Shall we get going, Hal? Hal, you can unmute yourself.
I am ready.
Yeah. And okay, Hal, now that we are talking about ADA, how is FASB adapting to new technologies and the new availability of these powerful data analytic tools in the industry?
Sure. That's a pretty broad question, and I really like it because as an investor, I was really focused on big data pools. And what I found as an investor was the bigger the data pool, the higher the quality of the data was incredibly important and really helped improve my performance over time. So this is a topic, at least from an investor standpoint, that's near and dear to my heart. We're going to focus a little bit more from an accounting perspective and to help frame some of this discussion. And I just remembered by looking at Dawn, I've got to give my disclosure that the views expressed are my own personal views. I'm a board member, and only the board can speak collectively in an authoritative way. So I'm expressing my personal views, but as you mentioned, based on a lot of experiences, personal experiences, including a significant time at the board. Let me start with the board's mission, because I think it helps frame your question. The board's mission is to establish and improve accounting standards. Sounds really good, but if you read through the objective, the mission of the board, there's some key phrases in there, and three that really stick out to me. We're establishing and improving financial reporting.
You don't have a charger?
Or financial accounting and reporting. Reporting is a key word there. we're providing information that's decision useful. Another key word, and investors and other users. I'll focus on investors. So what's meant by reporting decision useful and investors? If you focus on reporting, think of financial reporting as a supply chain. There's information that's produced by companies, it's distributed, and it's consumed. It's distributed, and I include the audit process as part of that distribution process. And then consumption is what it sounds like. Investors, users of financials, consuming, reading, and using that information. That's all changing because of technology, and we can talk a little bit more about that. Decision useful, that's a phrase that the board uses over and over again. But as you frame this discussion in terms of technology and data sets, I raise the question of decision useful to who? Is it to a specialist investor like myself who specialized in nothing but financial services, both US and globally? Or are we talking about a generalist who does financials one day and technology stocks another day? Very different decision usefulness depending on how well you know a particular industry. Bottoms up versus top down analysis, very different in the approach. So the information in terms of decision usefulness can vary tremendously. And then investors, my favorite, are we talking about man versus machine? Sorry about the usage of the term man, but I like the alliteration man and machine because it captures that progression as we use technology more and more to do investing. How does that change accounting standards? We have to think about all these things in the context of what the mission is. Now, what may not be as clear is in the US at least, we have a congressional requirement that we think about in setting accounting standards, we think about changes in the economy, changes in the world, and changes, most importantly, changes in the business environment. And technology is a big part of that change. So data analytic tools, what influences that have on the consumption or the production of information, we have to think about all that. Now, I'd like to tell you we've done a fabulous job and we're on top of everything, but it's been incredibly difficult when you consider the wide range of companies that we deal with, some very sophisticated companies to private companies and everything in between. Their range of sophistication is very challenging. So this has been a very challenging area for us in terms of trying to set a single accounting standard in terms of how it will be implemented and made operable against a wide range of expertise, and included in that is their technical skills in terms of their ability, not only for technical accounting, but in technology in terms of being able to apply and keep track of all the things that you need to keep track of in the standard. So it's been a big balancing act. There's a lot of discussion about the production and distribution and how technology has changed that. Consumption has changed tremendously because of cost and fee pressures in the investor world, and that is well talked about. So kind of boil it all down, I think we're aware of the need to consider technology and its advances and the implications for accounting, but we have to break it down into production, distribution, and consumption. I think we have a significant room to improve in this area because my personal belief is that when we write accounting standards, we still lean toward what I think of as a paper-based world. Even though we can get most accounting data through systems, it passes through, even in a PDF, I think of that as more as a paper-based world. We think in the confines of the four corners of a piece of paper today, and in part, it's because not all companies are at the high end of that spectrum in terms of advances, because we have a large, component of companies that are not as sophisticated. If we were thinking solely in terms of technology, I would be thinking very differently in terms of, say, something like the mixed attribution model that we have today, some fair value, some cost. Wouldn't it be better if we had a balance sheet that was all fair value and a balance sheet that was all cost? Let investors mix and match. Why should we as accounting standards say one is better than the other? I think both are very helpful. And if you have fixed fair value and cost balance sheets, why not fix fair value and cost income statements and then let investors discern what that means? But I think that's more of a technology approach. And I don't think the board's quite ready for that. We're still, like I said, more in that paper-based world. So we have a lot of room for improvement. Sorry for the long-winded explanation, but I think that helps set the stage for my own personal views. And particularly the consideration that we are dealing with a wide range of companies, thousands, if not millions, when you add in the private companies, millions of companies in the US that are following the US accounting standards.
That's very valuable knowledge to all of us. Now you talked about some kind of the data that is coming up. Now, FASB has made this XBRL, and first of all, what are the common concerns that are raised about XBRL?
Sure. I had a unique experience of hearing about it as an investor, and I got all excited. This is a great thing back in the 2000s. And then I had the experience of being a board member as it was just being launched and seeing some of the realities, some of the concerns that you referenced there. Let me start with the good news, because I was able to see the progression. I started from ground zero effectively to today. We've collected and tagged about 270 million data points. When we started, it was a few million here and we got all excited. Now companies are adding in the US about 25 million new data points a year to that database, right? So that's a pretty good clip in addition. So this database is growing pretty quickly. The differences between companies is interesting to look at, because you have the large accelerated filers, and only public companies, SEC filers, have to tag information using XBRL. But large accelerated filers average about 2,100 data points per quarter being tagged. The accelerated file is about 1,400, and then non-accelerated about 800. You can look up the definitions of what those are, but it gives you a range from largest, mid-sized, smaller firms, the amount of tagging that's going on. These averages vary significantly between industries. Financial services and area I specialized in, typical large bank stock would probably tag 3,000, 4,000 items in a financial sector. A lot of information being tagged. Obviously, other areas aren't nearly as intensive. And that average has been slowly ticking up over time. More information being tagged per company, but we've kept about 25 million data points per year because the number of filers has been going down. So you've got a rate volume variance, if you will, and it's been keeping that number of about 25 million, plus or minus a little bit. And you got to factor in the fact that some of these new standards like revenue recognition, leases, credit losses, all have significantly expanded disclosure requirements. So there's an interesting dynamic that I'm encouraging the staff to go and analyze a little bit more. I've seen some of the data, but I hope not only they, but I hope some academics can look into that and see how that is changing the amount of decision useful information out there. I think it would be a very interesting area. But let me get to your real question. Your question was about concerns. And while I'm a really big supporter of tagging data, I'm not telling you I'm the biggest advocate for XBRL. I think it's a tool, and I think it's a very useful tool, but there are some issues with that. And let me use the supply chain for financial reporting that I talked about before. On the production side, the biggest criticism I've heard over time is that it's exceedingly costly and exceedingly timely, or time intensive, right? It takes a lot of time and it costs money to do it. And the damning comment is, and no one uses it. Well, the feedback that you get when somebody says no one uses it, translated means no one has asked them a question about the tagging of their information. And I think that's a fair point. The reason for that is the data aggregators, the Bloombergs, the FactSets, and other data aggregators out there are experts in this. They don't need any help in understanding it. They're consuming it and then transmitting it out to their customers, who are the investors. So that information that tagging is all working as planned, and it's being consumed in different forms. So there's not really a need for a question. In terms of consumption, I think that if you think about the investor process of investing, think of it as this high volume consumption of information, a lot of data moving through the investor processing, right? Mm-hmm. And the last thing you want is non-standardized data, right? You want everything to be high quality, standardized information. Unfortunately, what we get in XBRL, and I'll kind of explain some of the reasons why, we get somewhat lower quality than is really desired, and it's not as standardized. So think of it in terms of that processing and the ability. And every time you get a non-standard piece of information, it can really throw your analysis off. You got to shut down the process, go figure out what the problem is, and then restart the process up. That can be very costly. So what are some of these errors or some of these problems? And first of all, they're just flat out errors. We can argue whether they're intentional or not. There's extensions. Those are the tailored, non-standardized tags. There's a lot of flexibility built into XBRL. It's not a closed system, if you will. It's an open system, and we can talk about open versus closed. Think of open as think of closed as tax returns, where it's a very standardized format. So things like that can really change how information is consumed. So errors, extensions. Extensions by themselves are not necessarily bad, but you have to understand how they're used, why they're used. And I think there's an approach that's being considered that is referred to as anchoring, where think about the standardized information. Everything is standardized at the top of the hierarchy, but if you want to do a custom or non-standard tag, you do it at the bottom, and it links into some standardized tag. So you just know that to avoid the non-standardized, you just stop at a little bit higher level in terms of how that information is tagged. There are some solutions there. My biggest concerns, though, about XBRL is not so much about XBRL itself, it's the timing of when information is available. That's the consumption part of this. The other big part of my concern is that there's no penalty for bad data. There's no audit requirement, and there's no penalties. You don't get in trouble with the Securities and Exchange Commission, which oversees this. There's no penalty. So if there's no penalty, do I really want to spend a lot of time and effort and cost, particularly if you think there's no benefit to that time, effort, and cost, and there's no penalties, you just maybe do something not quite as high quality, my personal view. But the delay in timing to me is the biggest concern. Think about when a company reports earnings and then when its tagged information becomes available. Financials are a great example of this. I used to get a 50 or 60 page earnings release for a company. None of that information was tagged. We had to literally key in all the critical data from that 60-page document into our models, and we had to do it in typically about 2 hours, because a press release would come out around 7 a.m. in the morning. The company is having their conference call at 9 o'clock in the morning. So you have roughly 2 hours. Now, there's a lot of chance that I'm going to miss key information, not consume the information correctly, but maybe there's something else going on here. If I'm using up all of my time keying in information, what does it take away from? It takes away from my ability to analyze the data before that 9 o'clock call. So maybe my questions aren't as well thought through or supported by data in asking those questions. Now, I'm not a cynical person, but maybe just taking a cynical view, maybe there's a reason why we don't tag earnings releases. There's no requirement. And why do you want to arm your questioners, the investors? Why do you want to give them better information quickly so they can ask you harder questions on a conference call, right? So maybe that's too cynical of a view, but that's probably my biggest concern is the timing of when tagged information gets to investors. And by delaying that tagging between earnings release and the filing, diminishes the value of tagged information, significantly diminishes it. because by the time you get the tagged information, that's several weeks. I've already made all my investment decisions. And the unfortunate thing is, I mentioned earlier, the average large accelerator has about 2,100 data points tagged in any individual quarter. I cannot key in, and my analysts could not key in 2,100 data points into our models, right? So we had to pick and choose. Frankly, we would pick and choose maybe 5 key data points per segment of a company. Say there are 25 data points out of 2,100. I think I would have made better investment decisions if I could automatically load in, rerun my models all within seconds, as opposed to having to key in the information. So to me, that is the number one issue, is the timing. And hopefully over time, that'll be rectified, but it's not something that the FASB can dictate. That is an SEC requirement in terms of timing, and they would have to take some action. And then there's a question about earnings releases and whether or not they're required. They're not required. So how do you mandate tagging for something that's not required? I would let me just add one more, because we're talking to a group of academics.
Right.
To me, another concern, and this is not expressed by companies, but I'm going to express it, it's the limited use of XBRL by academics. When you think about that massive data pool sitting out there, 270 million plus and climbing, but I don't see it being used in research. I don't see it being used very extensively in teaching in the classroom. But I say that when it is used, and I've seen it used in the classrooms, it can be incredibly powerful. So I'm hoping that by raising this as a concern, at least of my own, maybe others will start to spend a little bit of time and start to learn how to use it. But I appreciate that some of the concerns about data quality, but the data quality every place. And I think archival research in particular is not as sensitive to the timing of the information. You don't need it within seconds of its being released. A couple of weeks isn't going to hurt the archival research. But I think that the big hurdle is the familiarity, the ability to navigate and use XBRL. And I think that needs to be improved on. And maybe we can talk later about education and how what we're doing to help educate on that issue.
Thank you. Actually, my next question, I would like to delve into that a little bit, because you brought up a very useful thing that XBRL data is not being used by academicians. And, an issue that often is faced with accounting academicians is the availability of useful big data. You have a lot of big data available, but the ones that are useful for use in analytics and also for research purpose. And I think you are right that XBRL data is a good source of structured data that can be used in academic research and in the classroom. And so my question was, like FASB has started some XBRL training programs for academics. Can you tell us a little more about it, and how even faculty and people who are in international arena also, they can get advantage of that kind of training?
Sure. Let me respond. There are really two main avenues. There's the XBRL in the classroom, and that's being led by a woman named Christine Tan, who I've actually seen use XBRL in the classroom with students, and it's amazing to watch her respond to an ad hoc question from a student and say, oh, that's an interesting question. Let's explore that for a minute. And she'll, within seconds, have up on the screen in the classroom data supporting or refuting whatever the discussion question was. It's fascinating to watch. We've kind of taken that ability, and she's now teaching a class, and you can see her video on our website. We have a dedicated landing spot on the FASB.org that deals with academics and XBRL, and I'd encourage everyone to go to that website. I went to it and watched Christine, and having known her for years, watched it's about an hour-long video. It's pretty amazing, and she's fielding questions in that video. I would encourage you to really watch it. We've presented a number of conferences and workshops the last 2 years. We're going to continue that process of, particularly through the AAA, having this kind of in the classroom experience and helping academics learn how to use XBRL and how to use it in the classroom. The other avenue that we're looking at is using XBRL in academic research, and that's being led by Beth Blankenspore from, I think, the University of Washington. And she does her own video on using XBRL in academic research. I've met her over the years. She's very dynamic and very good at walking through. So I think those are two really good sources. Both of them are on our website and a lot of additional information. One thing I will highlight, though, we've got I'm going to get the date right here. July 13th this year, we've got a conference coming up, a Zoom conference like this, that's going to explore revenue disclosures and the use of XBRL. So I think that's something that is certainly worth registering for and participating in. And all these recordings are being archived. So if you can't make it on July 13th, you can at least come back and look at these. So I think there's a lot of good information. I just re-emphasize the website and the ability to kind of retrieve information. And as we were talking before the Zoom meeting started, we have an academic fellow. We're on our 4th academic fellow. They spent about a year with us. They are available to answer questions and get you in touch with the XBRL team. If you've got questions, feel free to reach out to whomever. The current one is Tanya Paul. She's coming in from Wharton, and she just started. I just met her yesterday, actually, just starting her 1-year term, and they're available to kind of point you in the right direction, help get whatever resources you need. I know that a lot of my comments are US centric. In terms of my observations, that's what I know best. I also know, though, from talking to our XBRL team, other countries are starting to do this level of engagement, but in varying degrees. One good resource is the EU and their website, the XBRL International, and I think it's just, it's xbrl.org, filings.xbrl.org. And what they have done is, because so many different EU countries are starting to head down this path, but they're in various places of making this tag data accessible or structured data accessible. What XBRL has tried to do is aggregate all of the different websites, country by country, and put it in one spot. So as a good starting point, you may want to explore the XBRL International's website and look for country by country where this information is being stored, or at least the portals that you can use to get to that information. So I'll stop there and see if there are any follow-up on that.
No, I think those are all great information. Now, let us now move from XBRL to ask something which has been on the minds of many of my students, and that would what I would like to ask is, why are we not having continuous reporting? At least in theory, it looks great.
I was hoping I'd avoid that question on this call. It's one of those things that sounds like a really good idea. And I remember reading some papers about it and thinking, wow, this is the new cutting edge. And this is 15, 20, 30 years ago. This topic was coming up. But I really start to question, is that really feasible? And if so, what are some of the downsides of it? So I think what you mean by continuous reporting is reporting every day. Now the question is it every business day, or is it literally every day, 7 days a week? That has a lot of ramifications, particularly if you're talking about sales. Wouldn't it be really nice to get sales of Saturday on Saturday and Sunday on Sunday, if weekends are the big, you know, there's a lot of just very simple high-level questions that need to be answered. But I think my reservations about continuous reporting start with the consumption side. Again, I'm going back to the supply chain here. A phrase that investors use often when there's so much data being thrown at them is they're drinking from a fire hose. And I think that's very graphic in terms of understanding how much you can only consume so much. And by pushing more and more and more, are you really helping or hurting the investors? And if, let's assume that you went down this path and you pushed a tremendous amount of volume of information to investors, are you really helping all investors, or are you helping tech-savvy investors, those who have developed systems to consume all that information, have the computers go through and sort through the information, and disadvantage more traditionally fundamental analysts who are sitting and listening to the conference calls, talking to the companies, doing supply chain checks and everything? There's a real advantage that you're giving one party versus the other, and what are the implications of that for the marketplace? I think there are a lot of other questions that I would get into. When would results be released? Before the market? After the market? Which market are we talking about? Are we talking about the same market but extended hours? We used to be able to say the market opened at 9:30 and closed at 4 in the US. Well, that's not really true anymore, because you've got extended hours in the US exchanges. Companies are dual listed. They're listed in various countries around the world. When exactly would you release that information? I think there's about an hour window late in the afternoon. I don't know if it still exists, around 5 or 6 o'clock East Coast time, when there's no trading anywhere in the world, or very minimal trading. Is that the one time that you would release the information? I don't know exactly how to respond to that. The other is, I think that there's some real benefits to getting information and then absorbing and reflecting on what that information means. And if you cut that opportunity to reflect and absorb, I think you get a very volatile market, a much more volatile market that's reacting constantly to every little bit of information. And I think that could be really unhealthy for the markets, create some unnecessary volatility. And unnecessary volatility would result, I think, in higher capital cost. So I can see a lot of negatives there. In terms of corporate governance, how do you implement internal controls and corporate governance around continuously flowing information? How does Reg FD, fair disclosure, report? I don't think I could ever meet as an investor. I couldn't meet with company managements because they were always feeding information into the marketplace. Some days it may be more significant than others. When would they have material information versus non-material information? How would that concept evolve over time? How would estimates work? How would impairment of assets, for example, or impairment of goodwill work? You could impair it one day, and if the facts reverse the next day, it's a one-way street. You only impair one direction. Would we have to change the impairment accounting standards? How does the mixed measurement, mixed attribution model work? Some assets are at cost, some are at fair value. Same thing for liabilities. Well, if I'm continuously reporting those things that are at fair value, whether assets or liabilities, are constantly changing, whereas nothing else is happening, so you could get some real imbalances in your income statement simply because of the mixed attribution model. Should we move to a different accounting model? I can go on, but it gives you a sense of, I'm not a big fan of continuous reporting, but I think it's a great thing to talk about.
Thank you so much for clarifying for many of us. Talking about data analytics, it is usually speculated that accounting estimates using analytics is probably more accurate. For example, if you are estimating allowance for doubtful debts, and then it is probably more accurate using some data analytic methods than the traditional methods. Similarly, valuation of an investment can be more accurately estimated using data analytics. What are your thoughts about this, and how can FASB bring standards that align with this new world of accounting?
Couple observations. One is when I was back as a portfolio manager doing my old job, I would quite often have those junior analysts come into me and start telling me about the numbers that just got reported. And I would listen to them, and the tone of their voice told me, ask a question about how much they think these numbers are accurate. And their initial response was, well, these numbers are accurate. The auditors have signed off on those numbers. They're accurate. And my standard response to them was, well, you realize every number on the balance sheet is an estimate, including cash. And their eyes would light up and like, what do you mean cash is an estimate? And I explained to them in my experiences, I had companies that had to literally estimate the amount of cash that was on board ships or in the casinos or wherever it may be because of the cutoffs and all the things that happen in terms of accumulating that information. So this notion that everything is an estimate is a little disconcerting. Now, over time, I think you're exactly right. I think that estimation processes have dramatically improved. I again mentioned the academics that we have on staff that come through the first one, and Dawn and I were talking about Kurt Gee, who now is at Penn State, I think, was at Stanford, got his PhD at Stanford. Kurt opened my eyes to how little my math skills, how deficient my math skills were relative to his. And I thought I had pretty good math skills, deficient relative to his. And then how much he educated me on how deficient his skills were relative to what I saw in some of the corporations. Credit losses, and I've talked publicly about this. When we were doing the credit losses standard, commonly referred to as CECL, we heard a lot about the expansive amount of data that was needed to be used to execute the standard. So we asked several banks to let us into the doors and explore with them what experiences were they having. Well, they started sending some information to us before the meetings, and I quickly realized I'm dealing with some high-level mathematicians here, and I used to audit banks and never met a PhD mathematician in a bank. I went into one bank that had 500 PhD mathematicians on staff. And the reason they did that is in part because of regulatory capital requirements and stress testing, things that have taken place in the US that are regulated and mandated. But they were starting to use those same PhD mathematicians to help do the accounting. Not because it was mandated by the standard, but because if we're going to deal with all this massive data for regulatory purposes, why not use it for accounting purposes? Why not use it for risk management purposes? So what we're seeing is, and I think one banker said it incredibly well to me, said, look, accounting hasn't caused us to do, this, scramble for more data. No, there were some really solid business reasons. All the accounting did was accelerate what we needed to do already to get better data, more data, better internal controls, improve our internal communication and coordination, improve our governance, improve our estimation processes. And so that's led me to a general belief that we're in this, I want to call it a virtuous cycle. Some like to refer to as a vicious cycle of more data, better quality data, okay, pushing that through the algorithms with higher speed, higher storage capacity, particularly through cloud computing, taking away the silos in data. All of that has led to this continuous improvement. Now, here's an area where we actually are getting continuous improvement, more data, higher speeds, more storage, better internal controls, better estimation processes, better internal controls, better coordination and communication, better governance. And once you start that, more questions get asked. So there's becomes a need for more data, even better data, more disaggregated data. One bank summed it up as, what we're now doing is this data has become so valuable to us and it's being used in so many different ways. We're putting it in a single silo and making sure that the internal controls around that are incredibly important. And we're charging each business unit for the use of that data. What was originally for regulatory capital and accounting purposes, we're actually now charging the business units. And once they know that they're being charged for it, they all of a sudden spend more time making sure that data is good because they're getting charged for it, and they're starting to use it in their business assessment for risk management and product pricing. So there's this constant virtuous cycle, all because of the ability to gain more data. And frankly, accounting is just latching on to that, seeing that trend. And we're saying, well, we're no longer afraid to require 6 times more disclosure about credit quality at a bank, which is now what's required, now 6-fold increase, because we know it's basically mirroring what's going on in the systems. As one banker, and just wrap this up, one banker told me, we could not have done CECL 4 or 5 years ago. The technology wasn't there, the speed of the computers, the storage capacities weren't there, but with the cloud and faster processing speeds, we're able to do the stress testing required by the regulators and accounting models like CECL much more readily. And I think it's one of the things that helped the banks get through the last pandemic. They were able to modify their systems and adapt to business shutdowns and then reemergences of businesses very quickly because they had spent all the last few years working on the accumulation and data quality. And that's where it all started, was improving data quality. Long-winded topic, but that is so close to a passion for me that, people always like to say, well, you accountants are making me collect this data. Well, if you didn't collect the data, how did you properly price the product? And that is, to me, I never have gotten a response from a banker, and I've asked this question numerous times in numerous settings. The comment will come out, well, what if we want to start a new product and go into a new geographic area? Okay, that's great. What would you do writing the business plan? You're going to go to the CEO. We have no idea what will happen here, but let's just start this new product. And here's how we're going to price it. Not based on anything, just our feel. I think the CEO would look at you like, maybe we need a little bit better business plan here. Maybe we need a little bit more data. It won't have to be all perfect, but maybe we should have that data. And I've yet to, whether it's leasing, revenue recognition, credit losses, get anyone to respond that going, oh yeah, we actually are using this information. And yeah, you're right, we couldn't price the product without some of this data, right? So there's a real business case, and effectively what we're trying to do is align accounting with what we know good business practices are. Credit losses, leases, revenue recognition, all fit under that broad umbrella, and they all are requiring more data, but we know that data is existing. And the reluctance is, yeah, we don't really want to share that data, but we'll say it's for other reasons. So anyway, sorry, you got me on my soapbox about data and accounting.
No, this is actually very interesting perspective, because we don't see thinking about accounting going from the business data always.
And think about cloud computing. And what were the reasons for cloud computing? One is lower cost. One is higher security. But the third reason companies have moved to cloud computing is it tears down the silos of data, and you're creating a single source of truth, as one company I've talked to calls it, single source of truth. And then they watch the data going into that single source of truth, and every analysis done within the company has to come from that single source of truth. So it doesn't matter if you're pricing or doing risk management or hedging, you're all using the same data, the same starting point. No longer do you get to have your own unique facts. to support your business case, you use the same single source of truth in terms of data. So we're all starting with the same point. Now that puts more responsibility in making sure that data is the right quality and hits on the right points. And companies have started to see weaknesses in their data pools, and that's why they've started to backfill and fill in where they should have had more data in the past, but no one individual unit wanted to go collect that information. Now it's part of the organization collectively, and now they're filling in with those holes in their data sources.
Yes,
It'd make an interesting academic study. Not that I'm pushing for this. But.
Well, definitely we should think in those terms too. Now, if we talk about certain industries like, say, the insurance industry, FASB has updated standards that kind of force the industry to be more data intensive and more agile in managing, analyzing, and reporting their data. What are your thoughts on these standards that FASB has put up, and is there some traction in FASB to come up with similar standards in other industries too?
Well, I would respond initially by saying we've tried to move away from industry accounting.
Okay.
Because when you think about, particularly in the US, these conglomerate companies, they tend to have a financial component and a non-financial component. Obviously, financial services is predominantly a financial component. They take deposits, they lend money out. But if you go to some of the manufacturers and some of the farm equipment manufacturers, auto manufacturers, they tend to have very significant financing operations inside. So if we were to write an accounting standard like credit losses, CECL, okay, and we said it only applies to banks, well, a bank but not a credit union, but not to company XYZ that has a financing operation, which, oh, by the way, when they produce that farm equipment, they make no money on the production of the farm equipment. They make all their money on the financing of the purchase of that farm equipment. So the standard would apply to the bank, but not the bank embedded in the manufacturing operation where the profits are coming from. It becomes very complicated. So what we've tried to do is focus on accounting by transactions. And if it doesn't matter if you have extended credit inside of a bank, a credit union, or a manufacturing operation, or anyone else, supply chain financing, just to name one area, it doesn't matter. The same accounting standard applies. A loan or a trade receivable, they're both extensions of credit. Some have higher risk than others. So we've tried to get away from, industry type of accounting and tried to get away from the form of a transaction. We're not going to do accounting for credit losses for loans and ignore trade receivables or other lease receivables, for example. We try to look at that collectively and write in a standard for the types of transactions or the risk involved, right? So that said, there are clearly some industries that are affected more by an accounting standard. Obviously, credit losses affects the banking industry far more than it affects many others, like a McDonald's, a fast food chain restaurant. Then there are issues like insurance. That's one of the rare areas where we actually kept it confined to things that we think of as insurance companies, but it's created some real problems because insurance is actually quite often the same product is offered by a non-insurance company in certain circumstances. So it's created some complications. I say all this because I don't want people to think we're picking out particular industries and we're being really hard on some industries and not others. We're looking at what is the problem that exists, what problem are we trying to solve, how is it best to solve that problem, and what are the costs, what are the benefits of solving that problem. Sometimes that burden falls more on one industry or another, but it's not intended to drive any particular practices in the industry. So I appreciate that, these issues exist. But the people in that industry, when you sit down and explain to them what we're doing, they start to understand. They may not like it, but they understand why we did what we did. Usually we start with what problem were we trying to solve, and that's where the agreement is, or disagreement can be. It's not so much the data or the effort. It's we either agree there's a problem or disagree there's a problem. That's the starting point. The second is, how can we best reflect the economics of the transaction? Does the current accounting reflect the economics of the transaction? Lease accounting is a great example of that. Operating leases were not reflected on the balance sheet. But when CEOs were complaining to me about, well, why are we capitalizing an operating lease? I just make that payment every month. I said, well, you just signed a 15-year or 20-year agreement to make monthly payments. Does that sound like a debt obligation to you? And they all go, yeah, well, do you think you can break that easily? No, then sounds like an obligation, sounds like a liability. Let's get the accounting to reflect the economics. Did that affect some industries more than others? Absolutely. But let's follow what problem, and does the accounting reflect the economics? And lease accounting, no, it did not.
Okay, that is a very plausible explanation.
I'm feeling better now.
Well, I'm feeling better that we now know what it is. Now, Hal, we don't have much time, so we will move to the last, but a very pertinent issue that is there in everybody's mind is about this blockchain and crypto assets. So shifting gears now, what is FASB doing about introducing standards related to cryptocurrencies? Like how will it be classified in the financial statements, and what will be the accounting treatment for these cryptocurrencies? What are the hurdles in coming out with such standards, and so on?
I was hoping I'd get through one presentation in the last 2 or 3 years without being asked a question about crypto assets and digital currencies and everything, but all right, you saved this one to the last. Okay, I can accept that. There are board members like myself who think the hype is far greater than the accounting issues, and that some of the requests for accounting rules and standards is really there to prop up and legitimize blockchain, and not that blockchain needs legitimizing. I think the math and the business cases for blockchain, I think, are there. But I think it's more to legitimize some of these cryptocurrencies and assets and everything. Well, look, the accounting is there, so it must be accurate. Going back to my earlier comments, there's a perception that if the auditors sign off on something, it's accurate, it exists, it's real. Well, if we have accounting standards, we'll need auditing standards. And if we can get accounting standards and auditing standards that make it real, all of a sudden it is real, and it puts these things in more and more into the mainstream. So I think there's one kind of discussion there. I think accounting is relatively simple for these. I would do it at fair value and be done with it, okay? But I don't get the final say on this. This is a board decision. And like many, in fact, virtually everything the board does is we go through what's referred to as an agenda consultation process. What issues need to be addressed? And currently we're working on our latest round. It's called an invitation to comment, or ITC. And the staff has been working on this and developing a series of accounting issues, including crypto accounting. And in the process of putting together this package, which will take each issue and say, explain what the problem is, what the economics are, and then what are some alternatives, and then ask stakeholders to give us their thoughts in terms of priorities. Which accounting issues should we be dealing with? Which are most important for us to deal with in near term versus longer term? We're gathering a lot of information, and in the next, from what I understand, by the end of this month, actually, this invitation to comment is going to go out. there'll be probably a 90-day-ish comment period. And these are kind of my thinking through the timing. And sometime late this year, maybe early next year, the board will start to deliberate this issue with other issues. So there's a process for assessing the problem. What are the alternative accounting solutions? Where does this fit in the priority of things that we should be focusing on? The staff has been meeting with people who are knowledgeable in this area. We're looking at what the AICPA is doing in this area. We're kind of just trying to gather information. We're monitoring international discussions. The International Accounting Standards Board has got a similar agenda consultation project going on. We're kind of, I'm going to say, in lockstep with them, not completely, but we're trying to, stay relatively in line with them, so that when they're starting to deliberate the issue, we'll be deliberating, and we talk to each other in terms of what the issues are and start to compare notes. Because I think if anywhere, I'd like to see this as a converged standard if we did something. But one of the other things that the board has been doing, the staff in particular, is monitoring right now what's going on with digital assets and some of the reporting that's going on here. And I'll just use two companies to illustrate it with the data sets, and maybe this is a good way to close this out. If that number appears in a US GAAP financial statements, it's going to get tagged, okay? So what we're starting to see is Tesla is tagging it one way. They're tagging it as an investment, acquisition of an investment. And there are a series of tags that go along with that. And a company called MicroStrategy, they're a worldwide provider of enterprise software. They're tagging it as an intangible. I'm not saying which was right or wrong here, but right now, if you went into this universe of trying to figure out who's got intangible or who's got crypto digital assets on their balance sheet, you'd have to know the different taggings. So this pulls us back to extensions and different ways of tagging things and some of the problems it creates with the data sets and the quality of those data sets and the usability of data sets. So this is a good area to close out on. We're already seeing differences in approach, and it's one of the first things that we look at in terms of deciding whether or not something goes on the agenda. Are there different accounting? Is the problem pervasive enough to warrant some accounting standard setting? And are there enough different approaches to what's happening that maybe we need some standardization of the accounting, but only if it's pervasive enough? So it kind of wraps up this. This is a good area, and it's something the board is looking at. So I'd stay tuned in the next couple of months and weeks and months to look at what the board does. Take a look at the invitation to comment, and it'll have some really good background information on it. You'll see what the accounting questions are that we've identified anyway. And if you think we're heading in the wrong direction or right direction, write us a comment letter back. Tell us what you think about that particular issue.
Yes, thank you so much for letting us know beforehand about it. Now, I'll take up questions, and actually, you brought up a nice thing in the last part about the process of how you come up with FASB standards, and that is actually very useful to some of our students who are attending this webinar. And so on behalf of them, and I would like to ask a very general question is, we talked about XBRL, we talked about data analytics, and then cryptocurrencies. How are these topics important for future of our students? And given that you have a like FASB scholarship for students also, so maybe you can say a few words about that.
I'm sorry.
So
I thought you were heading down the standard setting process, but right at the end, I thought maybe you changed direction.
Yeah, maybe I changed it a little bit, is that we have the process of the standard setting, which you have explained a little bit during the last part when you are talking about the cryptocurrencies. Now, on behalf of the students, I would like to ask a general question. is what are, we talked about XBRL, we talked about cryptocurrencies, and we talked about, say, data analytics, how important it is for their career as a professional.
I'm going to take the process of standard setting and take it in 4 chunks, if you will, 4 pieces. There's that pre-agenda research that goes on. Do we have a problem? Are there solutions? How pervasive is that problem? Okay. There's the standard setting process, and I'm going to divide that into 2 pieces. There's the accounting piece of it. How are we going to recognize, measure, disclose information about a particular transaction, right? Then there's the XBRL component of standard setting. I can touch on that in a little bit. And then there's the post-implementation review, which is once a standard is issued, there's a couple of years usually where companies have a chance to get their systems, improve their internal controls, improve their data, whatever they need to do, and then there's an effective date. So we're looking at those 4 periods as discrete, okay? During the pre-agenda process, the XBRL team in particular is really critical there because we're looking at information that helps us understand the pervasiveness of a particular type of transaction. And you say, well, gosh, these things aren't tagged, so maybe there's nothing XBRL can do. And actually, XBRL, we've learned over the years, is very useful because if you give us keywords, we can go in and use even keywords through XBRL to track down information and then start to find transactions that look or smell like something that we're trying to deal with. So in that pre-agenda process, is there a big enough problem to spend resources to solve? Yes or no? And XBRL is a big part of that. In the standard setting process, think of standard setting as a big decision tree. A simple example is we're going to account for the transaction. Should we do fair value or should we do cost? That's a major decision, tends to be made early on, and then from there, other accounting issues come out. Well, the XBRL team is working with the accounting team, if you will, and figuring out which path are you heading down. And once you start heading down that path, the XBRL team, because they have to provide absolute tags for every branch of that decision tree, okay? They need to understand all the different branches, and sometimes they can help the staff think through from a modeling perspective what the best tag is for a particular decision. And maybe that decision that you just made is inconsistent with another decision in the current standard because you've had to think mechanically through it, or it could be inconsistent with another accounting standard that the staff is not thinking about because the XBRL team has more of a holistic view. They're not tunnel visioned on a particular accounting issue. They're taking a look at the entire financial accounting reporting system and all the little tags that go along this decision tree. So it's kind of fascinating so that the XBRL team is engaged at every step of the way. And then when you get to the post-implementation, you start to see financial reporting. Even before you see companies reporting, a lot of the companies, particularly service providers that help companies tag their data, are brought in very early on to help identify tags. Well, those service providers are coming back and talking to the XBRL team within FASB to say, this isn't working quite like you thought it was going to
o Salcedo na coisa do Havaí, né?
Hello.
I don't think he liked my answer.
No, I think
what we found is that the XBRL team is critical throughout the entire standard setting process. They can't wait till the end, but we don't want them to. We want them involved at every step, and particularly in this after the standard goes out, because we're so busy monitoring, they're really helping us collect data, and they're showing us what companies are doing or not doing and where maybe they're not quite applying the standard the way it was intended, And we can see that through some of the disclosures, for example, where we can start our education processes at speeches, writings. We can get communications out to trade organizations and help correct any misapplications very early on. And XBRL is a big part of that process throughout the entire journey.
Okay, related to that, Hal, just help me out because I'm teaching a class on accounting and data analytics. So given that that course is going to have XBRL and data analytics and then cryptocurrencies, how important it is going to be for students?
Well, I've got some nieces and nephews who are right at college age and in college. And a couple of years ago, I told them the best thing they could do was take a class just like you described. Understand how data sets are assembled, how they're monitored, how they're maintained. Just understanding where the raw material comes from is absolutely critical because, and I hate the garbage in, garbage out analogy, but if you don't understand what this information means, it's going to be really hard to analyze it. If you don't understand all the accounting behind it and the exceptions to the accounting, the optionality that's embedded in the accounting, the greatest example, and maybe this is an example you can use in your class, is, there was this tug of war between the quantitative analyst and investors and the fundamental bottoms up reading the financial statements analyst, and we laughed at each other. The data people laughed at the fundamental. Why are you doing all that? The numbers will tell you the right answer. And fundamental analysts like myself were saying, you've never talked to the CEO and you don't know when he's changing his views on something because you're not listening to what they're saying. Well, I think both groups are coming together, and this has been talked about in various, articles and everything, but I'm watching that process, that intersection between these two groups are going to tremendously benefit from having a class like yours because it's teaching them not only how to use data sets, but how to make sure the data in those data sets is good data. And there have been a series of books written about Renaissance technology, which if you read that book, talks about how they improved their data quality and because they couldn't understand why their investments weren't doing as well as they should based on the data that they were using. And they made some slight adjustments to that data quality. And all of a sudden, their performance went from mediocre to phenomenal because the data quality improved dramatically. What I'm hearing, particularly from the quantitative folks, is that they're dedicating more time to cleaning up those data pools, extending the data pools, and when you start to extend it, you start looking at data quality and you start looking at inconsistencies in accounting from period to period, particularly when you adopt a new accounting standard. Credit losses is a great example of that dramatic shift from one accounting standard to another. Leases, all of a sudden leases are on the balance sheet, changes a lot of what you're analyzing and some of those past metrics. How can you normalize and smooth out those differences between periods? I think it's a fascinating area, and it couldn't be more relevant to what's going on in the business world today.
Thank you. So I'm taking up questions from the audience, and Professor Rajiv Dugar has this question. One of the main causes of non-standardization in XBRL output is non-standardization in classification. The same item can be spliced into different branches of the taxonomy. Can the goal of standardized data ever be achieved without standardizing the classification taxonomy?
I have to really sympathize with the sentiment embedded in that comment. I have sat in on let me back up. The XBRL team has a working group of people who are expert in this area and understand the modeling, and the term they use is modeling of the XBRL tagging and how and I can't tell you how many conversations I've sat in on property, plant, and equipment where they talk about this very issue. If you go down one path, it's tagged one way. If you go down another path, it's tagged another way. One of the questions that I've asked about is this notion of anchoring. And if you think about it as basic a level as possible, you have a few elements of accounting. You have assets, liabilities, equity, revenues, expenses, gains, losses. That's pretty much it. You've captured the waterfront in terms of elements, right? If we standardized, all accounting issues, all accounting standards link back to those elements, okay? So at one level, you could standardize based simply on, is it an asset or liability? Well, we want a little bit more information in terms of classification. So the accounting standards start to drive, well, what kind of asset? Is it a tangible or an intangible? That's the accounting standard, okay? We could standardize that level, okay? And then you've got optionality, okay, which derives from the standard approach. You could all make this flow back. So at the bottom of this hierarchy, what you would have is the non-standard customized tags, extensions, okay? They're extensions of the hierarchy. But if you anchored every extension to this decision tree and could get it back to, at some level, back to an, say, asset liability, you could then, once it's into that hierarchy, you could always sort out and have a consistent accounting, okay? But we haven't done that. We haven't taken an extension and anchored it to anything in the standard, into the taxonomy, use the right word here. We haven't anchored it into the taxonomy. This has been discussed extensively, but we're not in charge of that aspect of it. And that's really more for the Securities and Exchange Commission. They would have to mandate that, as I understand the issue. I would love to mandate it, but it's not in our scope of authority to do that. But it is being discussed from what I understand.
Rajiv, does that answer your question? You can unmute yourself.
Yes, it does. And in fact, I thank Hal for pinpointing the root of the problem as well, is that we could order things by asset liability by the 10 categories that FASB has. But then within that, you have liquidity preference, or you have uses, and then the different dispositions of the assets. I mean, if we go back to Peyton's original comment, all assets are expenses waiting to happen. Then the disposition of the asset through the income statement and the classification in the cash flows, the whole articulation question, that's another ball of wax, right? These are very difficult questions to which there is really, I was wondering if FASB is thinking in terms of a broader global sort of agenda that's being surfaced by the problems we have had already show up in trying to use XBRL. And I agree with you, it's useful, but it's not the final answer.
No, and let me just even take that a step further, particularly that last thought. We can come back to the international in a second. I wonder sometimes whether or not we're ready for the next iteration of structured data, if we're moving beyond XBRL. And I say that because one of the biggest problems, and I mentioned this earlier, is that the main point of an investor's focus is on the earnings release, but that's not tagged. Well, because that information is not tagged, you're forcing more work into the investor community, right? So what does the investor community do? Well, I've heard at least two major work efforts. One is just teach the computer to literally read the earnings release. The earnings releases are formatted the same way every period, all right? Well, as I understand from the computer experts, you can actually teach it and say, okay, the first line in the balance sheet is always cash. Go look to the right-hand side of that, and that's the number. And it can read that number and then go on, particularly if you know the font and everything, all right? Well, if you can read the earnings release, do you really need structured data? Now, the response to that is, yeah, any structuring that you can provide helps the computers get there faster. But there's a kind of a private sector solution that's already started to be developed. Another is some of the XBRL experts that have created businesses around it, people like CalcBench and Idacity, have started to tag earnings releases. Instead of teaching it to read, just tag the earnings release. And since it's the same structure of the earnings release from period to period, they're starting to say, well, we know what the tags are because we know the tags from the previous Qs and Ks. We know the tags, we know how they tag them. Well, we'll just assign that tag to the next earnings release, and then in effect, we'll tag it ourselves. So there's a lot going on here. The question is, have we gone kind of beyond the need? I still think we need some structuring, but if the Securities and Exchange Commission doesn't address it, I think the market is already starting to address it. Right? And in terms of international, there's kind of two work streams there. There's the accounting work stream. In fact, I think today we meet with standard setters from around the world, and we meet with them periodically, and their various groups. We sit there and talk a lot about these types of issues from an accounting standard setting perspective, and the XBRL team is doing the same thing from a tagging perspective, and we're all learning from each other. So those efforts are ongoing, but we're all in different starting places. So coming up with a unified effort and doing exactly the same thing around the world, because we're all in different starting spots, is a lot harder than we realize. And I can give you stories of why that happens, having worked for the Mexican government years and years ago. I thought they could easily adopt US accounting standards for banking industry. And the response from Treasury there, Ministry of Finance, was, no, we need to change the culture of our country before we can adopt your accounting standards. And I thought that was a very insightful comment, and one that it's resonated with me over the decades. There's a lot more to accounting than just a bunch of rules.
Hal, this is with Partha's permission. I have a direct follow-up. You've raised this question a couple of times now in your comments, and I thought it's very interesting. We've talked about standardization, but one of the things that we've learned from 50 years of accounting research is that actually allowing managers flexibility is useful because it reveals a lot more, right? Ye shall know by the path ye have walked. So I'm wondering where there is room for that as well. Management information revelation through choice of labels, through choice of taxonomy. Thank you.
Yeah, I can't tell you how many times I've made that same point to corporate directors. The conversation usually starts with, we hate XBRL, it's very costly and nobody uses it. And then I turn it around, just as you have, and said, well, this is your opportunity to tell your story through the tagging. Why do you avoid that opportunity? Because what's happening is the company, you spend all that time tagging, but the data aggregators are using their own tags and retelling your story. Sometimes they're close, sometimes they're not as close. Why don't you mandate that they use your tags in their system, or do a better job of communicating directly with your investors? Here are the tags, here's our story, and we're telling it through the way we tag information. I think there's a tremendous lost opportunity, and it all comes back to tagging earnings releases. If we clear that hurdle, if they saw the value in communicating their messages through that tagging, we would be a long way down that path. But I'm still suspicious about that 2-hour window between 7 o'clock on the earnings release and at 9 o'clock, the CEO being faced with a lot more informed investors. I don't know where that fits into the window, but I think that's a factor in the discussion.
Thank you.
Thank you. And now Ramesh is going to ask his question. Ramesh is from Dubai.
Thank you, Hal, and of course, Dr. Partha. Hal, that was fascinating insights into your world of standard setting and review. one thing that has troubled me all my 38 years of accounting has been reclassing previous year information. How does XBRL cope with this?
I'm going to take segment reporting as the classic example of what you're describing. And the story I've told at the board table in the past is whenever a company reclassified its segments and changed its segment reporting, it was a signal to short the stock because it was going to underperform everyone else. And my fellow board members looked at me and said, well, why would you do that? Because they go back and restate all the prior periods. And I said, no, they don't. And what I didn't realize at the time was that embedded, and my fellow board members didn't appreciate the prevalence of this issue, embedded in all that is you have to go back and restate all prior periods reported, is that last little sentence, well, but if it's impracticable to do that, you don't have to do it. And so I've done a little bit of counting in terms of how often it's impracticable to do it. It's a lot more often than you'd think. and so I think there's a real issue here, but it's a cost benefit. And I'm facing it on segments today. And unfortunately, I don't think I'm going to get the vote. In fact, I know I won't get the vote on the final standards, but we dealt with this just a week or two ago, and this very issue came up with, well, what would, the counter argument is, well, what would you have us do if they can't go back and restate? There's no opinion. There's a, the auditors can't sign off on the financials because they can't restate. What would you have us do? So I think it's a very frustrating discussion. I don't have a good, easy solution for you. XBRL, you would think, could help us track the relationship between the segment information and the consolidated, but the links aren't always clear. And I would say that would be an avenue to explore, but we're not there yet because the links between segment and consolidated are not always as strong as they need to be. And until we strengthen those linkages, then we're going to have real trouble with what you're describing. And I think what you're describing is a real problem.
Yeah. So segment reporting aside and the moral issue aside, if there is one, what is a practical solution when you have one source of truth, as you very aptly described, for all the years accounting information, all XBRL tagged, when the previous year's data is reclassed, not just segment, I'm talking about other portions of the reporting. So yeah. your classification changes, and therefore all your ratios done in the past all are up for a change. Yeah.
Yep. I think that's one of the where the quantitative analysts have really pulled their hair out because they know it messes up any trend analysis. I think fundamental analysts who really focus on trends have struggled with that. There's a real interest by a subset of these investors to understand what those disconnects are in their flow of information. I know personally what I did is I had my very lengthy spreadsheets that went column by column, quarter by quarter, would go back for years, right? And I marked where that change was, kind of like ice layers in an archaeological dig, right? Layers of sediment and everything tell you a story. Something happened here. I had those marked in my spreadsheets. Not all investors think like that. They only think forward. They kind of ignore the past and try to think only forward. I struggle a little bit with that, but that is a kind of a cost-benefit decision that every investor has to make. How much do I go back and restate my information? Some investors have told the board, we don't go back and do anything with that restated information. When the preparers, the companies hear that, well, why are you making us go back and restate? Why can't we adopt the accounting standard prospectively? Only new transactions get the new accounting. And that has ramifications for what you're talking about. It comes down to really a cost-benefit debate. And it's costly for the preparer to go back and retroactively restate all the information, regardless of what the issue is. it's costly for the consumer, the investor, to go back and plug all that information into their models, particularly if you're doing it manually. So that's where the quants have been trying to smooth out those inconsistencies, particularly for accounting changes. And this is a great area where you're giving a real competitive advantage to the quants that crack the code for being able to do it economically. But it comes down to economics. And I know I dealt with this all the time. How far back do I go back and restate? And after a merger, quite often I didn't even go back and restate because the merger was significant enough. The trends in the past did not matter. Right? So,
Great,
long-winded way, I'm not going to give you a solution today. It's a real problem. I think technology can help solve the problem, but it will not solve all the issues.
Thank you.
Now, there is a doctoral student who has asked a question. His name is Rohit Radhakrishnan. Rohit, can you unmute yourself and ask the question? Well, let me ask the question on his behalf. He's is asking, would advancing of cryptocurrency could have any major influence on the reporting and also could motivate the executives in earnings management using crypto?
So the question is, can you manage earnings through cryptocurrency?
Yeah, means I'm reading exactly what it is. And
yeah, that has been raised occasionally, depending on how you value. Do you account for it as cost, your entry cost to that? Are you accounting for it at exit price and in fact fair value? Could you manipulate the market at a particular millisecond that you're going to use as your basis for the financial reporting, say at the end of a quarter? On March 31st or June 30th, I do a transaction right at the last second that pushes that currency up or pushes it down, depending on how you're positioned. Given that some of these markets aren't that fluid, I could really see how that could happen. But then what's the alternative?
Okay. Yeah. So Ashish Kumar is going to ask a question on fair value accounting. Go ahead, Ashish Kumar.
Good evening, sir. Actually, in India, we are for just implementing IFRS, just converge in Ind AS. The Ind AS has given us the autonomy to select in between the cost-based accounting or fair value accounting. But as far as fair value accounting is concerned, so I believe that has increased the scope of the applying manager's discretion. So what's your opinion as a regulator?
The communication wasn't particularly good here. So is the question about my views on fair value accounting versus historical cost, in which is better information?
The thing is that the fair value accounting has increased the scope of the manager discretion in reporting. What's your take?
Oh, okay, gotcha. I am a strong believer in presenting both fair value and cost. And when again, going back to my investor days, when I got the balance sheet of a bank, we took every single asset and anything that I didn't have fair value for, I sent across to the hall to the people who were experts in fair valuing financial instruments in particular. So I looked at the information and really scrutinized what's cost, what's fair value, what are the implications, how are they managing their business. But one of the things that, and I'm going to see if I can describe this simply, I would take the fair value number that they presented because I was concerned about their discretion in that and reverse engineer how did they come up with the fair value for that number, particularly for things that were not as actively traded. It was level 3 in US GAAP terms, types of information where there are a lot of assumptions and modeling. Well, let's see if we can reverse engineer. How did they get to that number? What would the underlying assumptions have to be? Because we knew generally how they were modeling, how they were valuing something. Well, let's see if we can get to something that we agree with, or we disagree with their assumptions, or are their assumptions unrealistic? So I think that while that requires a higher level of knowledge of fair value accounting and modeling and valuing financial assets in particular, it can be done. But again, I think this is one of those where until we come up with a standardized method of valuing everything, which I don't think we ever will, I think this is just a reality. Some investors will have a competitive advantage over others. And I think there are real justifiable reasons why one entity comes up with a different fair value than another. I've been involved in those situations where we had all exactly the same information for the same asset, and I came up with a value that was 85% of the value that they came up with. And they came up with a number that was actually 15% higher than the book value. So I was 85% of book value and they were 115% of book value. That's a wide disparity for two people who were fully knowledgeable about the transaction. But I could then back into why they got to their answer, and it helped me point out the flaws in why they were coming up with what I thought was a wrong number. As it turned out, in that particular example, I was over optimistic. The number actually came in about 5% lower than the number I had come up with, and I was the low end estimate. So I appreciate there's opportunities for manipulation. There's also opportunities for real differences of opinions. But I think knowing the fair value, knowing the assumptions, then I can challenge those assumptions. I don't have to take them at face value.
But still, valuation is a vague concept. As you stated, it is based on a set of assumptions that is very subjective.
Absolutely.
So if I want to convey to my stakeholders through my financial statement using the fair value concept, so how would it be possible? Because then, in case of historical cost concept, the information is reliable. But in case of fair value, no reliability as such is there.
I can have something that's factually accurate. That would be cost. What did it cost me to get into a particular asset? And could be totally irrelevant to my decision process as an investor. And this is an argument that comes up, and I always use, an international brand like Coca-Cola, all right? We can sit there and debate what the value of the underlying assets are of Coca-Cola, but I know for a fact that if you took the cost of developing just simply the formula for Coca-Cola in the 1880s was pennies, literally pennies of ingredients in the 1880s for the original Coca-Cola formula. If we had that on the balance sheet, how would that be decision useful? It may be faithfully representative of what they spent in the 1880s, but it has no relevance to today. So I appreciate the comments, and that's why I've actually argued for both a fair value and a cost balance sheets. And I think that would be a reasonable way to do it. And I think technology would certainly support that. But then you get the question of, well, is it the cost in the 1880s, the cents on the dollar, or the pennies that you spent in terms of the formula, developing the formula? Or is it those pennies in today's dollars? Do you adjust that for inflation? We can have a lot of debates, but at this point, we're kind of stuck with this fair value approach. And honestly, and I've felt this way since I took accounting in the 1970s, fair value, kind of the current values, if you will, are far more decision useful than cost. And I'm, as an investor, my tolerance for accepting ranges of answers is much higher than an accountant's. As I jokingly say, as an investor, if I get 60% of my trades right, meaning I make a profit on 60% of my trades, I can make a pretty good living. If I make only 60% of my accounting decisions right, I'm probably unemployed or maybe going to jail. Accountants think in terms of 99.999% accuracy, and investors are used to dealing with estimates and understand that these are simply estimates. Not all investors, but the good investors understand these are all estimates and need to be challenged. And that's what makes the market work. We all can come to different answers and different conclusions based on the same purported information.
Thank you.
Thank you.
Now, Hal Elkins has a question from Canada. Hal, can you ask the question yourself?
Oh, hope you enjoy your time. Oh, nope, it disappeared.
Yeah, I can ask my own
sorry.
question.
Okay.
Hi, Hal. It's nice to meet another Hal. There aren't very many of us out there.
Excellent.
So my question really is to do with the comment letters that you receive, and how much influence do comment letters have on the different board members? Do you read all of them? And a follow-up to that is, does the respondent category, in other words, if it's a preparer or a practitioner or a user or an academic such as myself, or perhaps another standard setter, if the IASB were to write something coming back to you guys, does that carry more weight in your view or not?
Yeah, let me answer it from my perspective. And I say that because every board member handles comment letters and feedback in general. Comment letters are just one form of feedback. They tend to come from preparers and trade organizations. Investors write very few comment letters. I may be one of the few investors that actually wrote a comment letter on fair value, shockingly on fair value. So we have to go and get information from investors, users in other ways by interviews, because they don't like to be public about what they say. So I'm giving you kind of the lay of the land. Some issues get a lot of excitement. Fair value accounting, credit losses, we have thousands of letters. Others we get a handful, a couple dozen. All of them are posted on the website. The staff read all of them multiple times. We read them all. In terms of weight, I like to look at the arguments that are being made and how sound and consistent are those arguments being made, particularly by that individual company. One of the fun things to do is read, and I won't name the company, but on the credit losses standard, okay, the same company had 3 different arguments over a 4 or 5 year time period, diametrically opposed to each other, depending on arguably who the CEO and CFO were at the time. I'm just saying, you got to kind of filter each and understand, are they making a consistent argument over time? And if not, what are the motivations? What are they trying to achieve here? A lot of times they like the result here. They don't care how you get it, right? It's not conceptually supported, or it is conceptually supported. So those are a lot of the things that we end up weighing, at least I end up weighing. And I'm really looking for operational issues. And I tend to focus more on the preparers for that. Obviously, for the auditors, I tend to focus on the auditability of an issue. And then for the investors, the usable. What are you doing today? Are you capitalizing leases or not capitalizing leases? And when the preponderance of information we got back from users was, we capitalize our leases. Okay, game over on that issue. They're going to get capitalized. Now, how do we operationalize putting the asset and liability on the balance sheet? So I'm kind of walking you through that thought process. I'm not looking at numbers. I don't care if there were 100 letters in one way and one letter another way. If one letter comes back and clearly articulates an argument either for or against, that to me is going to carry far more weight than the other 100, particularly if the other 198 of them are form letters, which is sometimes what we have too. So there's a lot in there. A similar question, you didn't mention congressmen. Occasionally congressmen like to write us letters. Translate, trade organizations wrote the letters and had the congressman sign it. Those don't carry any more weight with me than anything else. I look at them, I appreciate their arguments, and but the fact that it's a congressman or a senator doesn't carry any more weight with me. And I would say the same thing with the IASB. or any other standard setter, I listen to their arguments and I look for who has the best arguments. And the best arguments don't always come from standard setters or regulators or politicians. Sometimes they come off from academics, and I love the research. Academic papers to me are quite often the best papers because they're backed up with facts. And that's the one thing I really love about. They're occasionally, not all academic papers are, sometimes they're more opinion pieces, but I really like the ones that have been backed up with not only archival information, but I also appreciate the behavioral research that's sometimes done. How do people react to fill in the blank, whatever the question may be? I think of people like Pat Hopkins out of Indiana University, who's done some behavioral stuff that I found just fascinating. So keep those cards and letters coming. They're greatly appreciated, and we do go through every one of them painstakingly sometimes.
Thank you. That really helps a lot.
Sure.
Thank you. And the last question is from Subhra Tripathi from Subhra, can you ask your question, please?
Yeah, absolutely. Greetings from London. So I used to be an academic at the London School of Economics, and I work in fund management now. So what I noticed when we look at big data, AI, and NLP, etc., there seems to be a two-speed progress. So the fund management industry and the financial industry in general are miles ahead in terms of not just using, but developing some of those technologies. And for very understandable reasons, academia is nowhere close. They just can't have all the databases, the technology licensing, etc. They are still stuck in the old factor models in terms of asset pricing. So do you see a risk that 3 to 4 years down the line, our students will be learning, the PhD students, the master students will be still learning what's in the past, whereas the mainstream industry will have moved into more AI-based investment processes?
Yeah, it's kind of the digital divide. And sorry, the communication line was a little weak here. But there's a real digital divide. And what I heard you say was you now, coming from an economics background to a funds management background, and you've got more resources at your disposal. Does that give you an advantage over others? And how can students be better prepared and what they may be learning in class isn't exactly lined up with what's happening out there? I think that's always going to be the case. When there's a dollar incentive to learn something and you can spend more money on getting better data and better algorithms and better analysis, somebody's always going to have a competitive advantage. That competitive advantage is in some ways driven by fee structures in the industry. And I like to use the example of ETFs. ETFs have driven down the cost of investing in long-only funds. And as a result, it's put tremendous pressure on the active manager industry to drop their fees. Well, if they're dropping their fees, then they're probably got to look at ways to decrease their cost, and their ability to manipulate, manage numbers and analyze numbers and make investment decisions off of that have all come down. I hope that's being taught more and more in schools, but it comes back to all that we've talked about, the quality of the data. While we can do a lot of this, I don't think there's anything that accounting can do at this point. Some of this is regulatory, forcing better quality data, better tagging, the education process, having, like I mentioned earlier, not only the research that academics do, but using it in the classrooms, more real life examples of how data can be used to make decisions, I think is very important. And I know that as my daughter approaches college age in a few years, one of the things, if she has any interest in business, is going to be exactly that. What is the business program in that school doing and teaching?
Yeah. Thank you.
Thank you so much, everyone.